Thanks everybody for joining us today on Monday morning, the 21st of March. It's been one of the worst starts to the year on record for equity markets. Against that backdrop, we felt at Merrion Investment Managers, who are the institutional asset arm of Cantor Fitzgerald, it would be good to look forward to what perhaps could go right for the rest of the year. I'm Byrne, Head of Equity Investments at Merrion Investment Managers, and I'm joined on this recording by Conor McDermott, Head of Technical Analysis, and Diarmaid Colreavy, one of our investment analysts. Conor, I wonder, could you just set the scene for the listeners and put into context just how bad markets have been year to date?
Yeah, that's a good question, Phil. So I guess at the recent lows in March, many markets are down for the year over 20%. And in fact, for some regions, it was the worst start of the year in history for equity markets. So that's such a extreme moves. But it's important to note that I guess historically, year-to-date starts like this, where weak sell-offs at the start of the year, have been preceded by strong rallies for the rest of the year. For example, some context, the 5 worst starts of the year prior to this were 2009, 2020, 1935, 1933, and 82. And these are all followed by tremendous comebacks for the rest of the year. In fact, the average return when the S&P was down over 10% in March for the rest of the year was 25%, with a median return of 33%. So that's, and I guess people are saying, oh yeah, in 2008, the market was also down 10% and the market finished the year poorly. But in context, that was a great financial crisis. And at that stage, the banks were not that well capitalized and the consumer was way more, much worse situation there. So it's different kind of, market to then. So yeah, based on history then, there is very strong returns looking forward for the rest of the year.
Okay, and with that evidence, what are we seeing? What have investors done year to date? What does positioning and sentiment look like after the start to the year we've had?
Well, over the last couple of weeks, I've noticed a number of very extreme kind of bearish sentiment and positioning versus history. So a lot of stuff now looks like what we saw back in March 2020, where many of the indicators are kind of like, the market low in 2020. For example, according to a recent fund manager survey, cash levels were at multi-decade highs. And historically, if you bought at these extremes, you were significantly rewarded going forward. And heavy cash is kind of fuel for bull market, because as people are in cash, they're going to force to buy back in as the market trends higher. Also worth noting as well, one investment bank, this is 2 weeks ago, on their data, it was the highest ever short position in Euro Stoxx futures. And as well, another bank mentioned as well that they had seen the largest 10-day degrossing by hedge funds in history. So in answer to your question, sentiment's so bearish here, everyone's kind of, has raised cash, which is supportive of an upside rally as the news flow gets better.
Okay, interesting. And obviously the last 3 or 4 days, we've seen quite a strong rally off these lows already, 3 to 4%. A lot of commentators this morning, first thing, are saying this is just a classic bear market rally that'll fade. Is there anything you can point to in the data recently that actually this is the start of a rally as opposed to the end of one?
Well, it looks like across many markets, we've seen a bullish trust, which is like when you have strong volume and price action on the one day. And we actually had, in fact, the strongest 4-day breadth trust in history for the Nasdaq 100. So these sort of moves historically seen coming off a market low at the start of a new cyclical bull market as opposed to a short squeeze. And it's also worth noting that the prior times we've seen such a kind of bullish trust off the lows, the US market's been higher every single time 1 year later, with an average return of 25%. So overall, putting together, the setup is there for a strong rally into year end.
Okay, so historically, the precedent is there for a strong rally. I suppose for us now, we try and look at what could trigger it and what could make this rally sustainable. Even before the invasion of Ukraine by Russia, markets were weak. As we know, the biggest concern was inflation and the impact that was having on central bank policy, where we saw one of the largest pivots from the Federal Reserve, who are now forecasting 7 rate hikes this year, as opposed to forecasting no rate hikes as early as 4 or 5 months ago. The bellwether, of course, for inflation is oil, and it's quite sensitive at the moment. Diarmaid, I wonder, could you just talk us through the oil market itself and where, if anything, some positive surprises could come from? As we know, oil's gone from $50 to $150 in 6 months, but it has fallen back below $100 over the last 3 or 4 days. What do you see looking out for the oil market?
Yeah, absolutely, Phil. Thanks. So as we know, the oil market is very tight at present. So the demand picture is clear. Now maybe we do get some relief in the near term with Chinese lockdowns, but I think the supply side really is what's key, and is there potential sources to come online. So there are a number of areas where we could see that supply coming online. First of all, there is progress being made in discussions with Iran and lifting restrictions there. So they are producing about 2.5 million barrels a day. They also have some inventories that could be brought online pretty quickly. And they were producing as much as 3.5 million barrels per day back in 2017. So there is upside there. We also see some progress in US discussions with Venezuela, who've been shut out in recent years due to sanctions as well. Production there has fallen. It was less than 1 million barrels a day last year, but it has been ramping up slowly. And they were producing over 2 million barrels a day back in 2017. So there is potential there if investment is allowed back. If we look at OPEC, there's spare capacity in both Saudi Arabia and the UAE, over 1 million barrels each. And there's maybe 500,000 barrels in Iraq. We've also seen some comments from US shale producers that they'll increase production, and we have seen a pickup in permitting activity in the Permian Basin recently. So if we were to look at maybe a blue sky scenario in terms of supply, we could potentially see over 5 million barrels coming back online.
Okay, interesting. And obviously that's the supply side. What about the demand side as we go out? One of the impacts of the Russian invasion has been an acceleration of the decarbonization targets from Europe, which are obviously going to have long-term impacts on oil demand. What are we thinking about that?
Yeah, no, absolutely. I mean, I guess the first point would be, oil to GDP intensity has been falling for years due to efficiency gains, and obviously the energy transition is going to accelerate this, whether we look at EVs or decarbonization, renewable energy. So as you mentioned, Europe, the crisis is going to accelerate the energy transition. So for example, German renewable capacity will need to increase by about 3x to meet the new coalition targets. So some key beneficiaries would be Vestas, for example. They're the leader in onshore wind turbines, so they'll benefit from accelerated permits there. Ørsted will benefit from accelerated seabed auctions on the offshore side. And of course, hydrogen capacity in Europe will potentially double, which would benefit electrolyzer producers such as ITM.
Okay, so much like coming out of COVID, what we're seeing is fiscal policy in Europe will do much of the heavy lifting to try and stabilize growth expectations going forward. And I think as you touched upon some of the stocks there, but there's numerous sectors within Europe that will benefit from this increased decarbonization. Another area of fiscal spending, which we're going to see to support the economy, and this is at a global level, is going to be defense. I think we've seen now all of NATO's all of NATO members saying they will hit their 2% targets for defense spending. Can you put some numbers around that, what that means for in dollar terms?
Absolutely. So in Europe, again, the largest increase has of course come from Germany. So there's going to be 100 billion in the budget this year for military equipment. And then, as you mentioned, they're going to meet the 2% NATO target on a sustainable basis. So that's recurring spend. So if we were to take all Euro area countries reaching that 2% of spend, that would represent an additional 50 to 80 billion euros in spending this year, and up to as much as 120 billion next year. So one beneficiary would be Rheinmetall, who could potentially double their German revenue off the back of these numbers. And as you mentioned, it's not just Europe. So US defense spending is also set to increase. At the moment, the budget next year is projected to be about $800 billion, but that's probably going to be the floor in the medium term now. So that represents about 3% of GDP. On average, over the last 10 years, spend has been about 3.4% of GDP. But given the new geopolitical backdrop we're in, it's conceivable that could move as high as 5% of GDP, which would be within historic ranges if we look back further. And that would represent a 1.2 trillion budget. So obviously a material increase from today's levels.
Interesting. So suddenly we're starting to put together a picture where markets have had a very poor start to the year, but actually we can see through where we're at peak hawkishness for central banks. We're seeing certain areas will actually benefit from the disruption we've seen, namely decarbonization and defense. But there's also been other positive signs in the last week, particularly out of China, but the investors may have noticed the Chinese technology companies had fallen 80% in the last year, and have in the last week have started a bounce off the lows. Conor, can you elaborate on what's happened in China there?
Yeah, well, like effectively, like, you know, I guess like February last year, like the Chinese tech market peaked, and a lot of that was driven by, you know, increased regulation concerns, and that's been kind of the case. Like the headlines have been very, you know, poor for the last year regards regulation. But I guess last week headlines, you know, suggest maybe we're past peak regulation. Comments from the Chinese State Council, they're coming to ends of regulating platform companies. So they've had a decent rally since, but, you know, given the sell-off, they're still early days. The stocks are, you know, very cheap versus history, and also particularly against global peers here. So any kind of further rally here would also help sentiment across the markets, across tech space. So I think it's encouraging signs, and I can see the Chinese tech stocks, you know, do well from here going forward.
Thanks. So thanks everyone for listening. Just to sum up our thoughts, you know, against what's been the worst start to the year on record, we're at very low investor sentiment. We can see lots of potential opportunities between now and the year end. History is on our side for performance. Monetary policy, particularly in the US, appears to be nearing peak hawkishness. Fiscal policy in Europe is accelerating, and regulation in China is improving. These are all areas we think where things could go right for markets as we look into year end. We would also just like to highlight that to look at the things that are going right, the longer term investment trends that we've spoken about at length on all our webinars: digitalization, decarbonization, deglobalization. These are long-term trends that no matter how difficult the current economic backdrop is, that they will continue. Thanks everybody for listening. If you have any further questions or interests, please do contact your Cantor broker.